Let's be honest, earnings reports can be, well, a little dry. Just a sea of numbers, right? But sometimes, if you look closely, they tell a really fascinating story. Today, we're unpacking the latest report from mortgage giant PennyMac, and trust me, it's a classic tale of two engines pulling in completely opposite directions. So let's get under the hood and see what's really going on.
So let's just start with the headline number. In the fourth quarter of 2025, PennyMac pulled in a net income of almost $107 million. Yeah, on the surface, that sounds pretty solid, doesn't it? A profitable quarter for a huge company?
But here's the thing, that one number, it's hiding this dramatic push and pull happening deep inside the company. So the real question is, what forces were battling it out to land on that final figure? That's what we're going to break down.
To really get it, you have to understand that PennyMac is basically running on two different engines at the same time. You can think of them as the company's offense and its defense. Okay, so on one side, you've got production. That's your offense. They're out on the field, actively trying to score by creating brand new mortgage loans. Then you've got servicing. That's your defense. Their job is to manage the huge portfolio of loans that are already on the books, collecting all the payments, handling escrow. You get the idea. Two totally different jobs.
All right, now this is where the plot really thickens. In the fourth quarter, changing interest rates drove this massive wedge right between these two engines, causing one to soar while the other just stumbled.
So first, let's talk about the offense, production. When interest rates started to fall, the side of the business that creates new loans had a fantastic quarter. Why? Well, more people wanted to get new loans or refinance their old ones. And you can see it right here in the numbers. The production team's pre-tax income ticked up nicely from about $123 million in Q3 to over $127 million in Q4. Yeah, that's solid, healthy growth, and it's exactly what you'd expect to see when rates are falling. But, and this is a big but, let's flip over and look at the defense. For the servicing business, that same drop in interest rates that helped out production was, well, it was a major problem.
And whoa, just look at this chart. The contrast is stunning. Servicing pre-tax income absolutely cratered. It went from over $157 million in Q3 all the way down to just $37 million in Q4. I mean, that's a nosedive of more than 70% in a single quarter.
So, what on earth happened? How can lower interest rates be a good thing for one half of the business and a catastrophic thing for the other? Well, the answer comes down to one key financial asset. It is all about something called mortgage servicing rights, or MSRs for short. All this is really is the right to collect mortgage payments and earn a small fee for doing it. But here's the catch. When interest rates drop, what does everybody do? They rush to refinance their homes at that new lower rate. That's called prepayment. And when a loan gets paid off early, poof, that future stream of servicing fees just vanishes into thin air, making the MSR asset way less valuable. So this brings us right to the heart of PennyMac's whole game plan. They've deliberately designed their business to create what they call a natural hedge, where one side of the house is built to offset the problems of the other. And you don't have to take my word for it. We can hear it straight from the CEO, David Spector. He explains that the boom in new loans on the production side is specifically designed to cushion the blow when the servicing side takes a hit from all those prepayments. The very thing that hurts servicing, lower rates, actually helps production. It's a built-in balancing act. All right, so Q4 was a roller coaster, right? The offense scored just enough to cover for a struggling defense. But the real question is, does this whole balancing act actually work when you zoom out and look at the entire year? Let's check out the full year report card.
And you know what? The answer is a huge, resounding yes. When you pull back to see the full year, the strategy is clearly paying off. I mean, just look at the net income. It's skyrocketed from around $311 million in 2024 to over $500 million in 2025. And it's not just one number. Look across the board. Revenue, loan production, every single key metric is up and up big.
And this right here is the crucial point. Despite that absolutely brutal fourth quarter for servicing, when you look at the full year, both engines posted really impressive growth. Servicing income for the year was up a massive 58%, and production income was up 19%. So yeah, over the long run, that hedge, it worked like a charm.
But hold on, the story isn't quite over, because tucked away in that earnings report is a little glimpse of the next big challenge brewing on the horizon, not just for PennyMac, but for the whole industry. And again, it's CEO David Spector who points it out himself. He says this excess capacity has created an intensely competitive market.
In other words, there are too many lenders chasing the same customers, and that squeezes the profit margins on the very loans that are so critical to their balancing act.
And that leaves us with the final critical question. That natural hedge strategy worked perfectly to navigate the ups and downs of interest rates. But now, as the market gets more and more crowded, can that great balancing act continue to perform? Well, that's the story to watch in the quarters ahead.